Right now, it's going on June 1st, and that's the way it is. No, they haven't treated us properly. They haven't treated our country properly. We had a very nice call, and I agreed to move it. I believe June 9th would be, July 9th would be the date. That was the date she requested.
President Trump again sending markets into a tizzy, granting the EU an extension on the 50% tariffs he threatened on Friday. Live from Singapore, this is Insight with Haslinda Amin, a show where we bring you context and sharp analysis on the uncertainty around trade. We'll find out firsthand how the Fed is viewing the latest tariff turmoil, as well as what Trump calls his big, beautiful tax bill. Minneapolis President Neel Kashkari joining us in just a moment. The latest trade twists also sending the dollar to its lowest level since 2023. Treasury Secretary Bessent tells Bloomberg he wouldn't call the currency weak. We'll assess the impact of that on emerging market earnings and equities with Amy Oldenburg from Morgan Stanley Investment Management. Plus, the ASEAN Summit begins in the shadow of U.S. tariffs, with China looking to develop closer ties with the bloc. The latest live from Kuala Lumpur. Investors reacting positively to the latest headline from President Trump's twists and turns on trade policy. Trump says he's extending the deadline for the EU to face 50% tariffs until July 9th. That follows a phone call with European Commission President Ursula von der Leyen. We heard from the president earlier speaking in New Jersey.
We had a very nice call, and I agreed to move it. I believe June 9th would be, July 9th would be the date. That was the date she requested. Could we move it from June 1st to July 9th? And I agreed to do that. And that she said we will rapidly get together and see if we can work something out.
Well, that's a quick turnaround phase from Trump after he threatened those higher tariffs on the EU just last Friday.
I'm not looking for a deal. I mean, we've set the deal. It's at 50%. But again, there is no tariff if they build their plant here. Right now, it's going on June 1st, and that's the way it is.
Meanwhile, U.S. Treasury Secretary Scott Bessent has been sounding an optimistic note on progress in trade talks. He also spoke with Bloomberg earlier.
We've done a deal with the UK. My sense is over the next couple of weeks, we're going to have several large deals announced.
And we'll have more from our interview with Treasury Secretary Scott Bessent a little later. Now let's bring in our guest. Neel Kashkari is president of the Minneapolis Federal Reserve. Neel, good to have you with us and welcome to the region. This flip-flopping of policy that we're seeing from President Trump, I'm just wondering, is it adding to the lack of clarity for the Fed?
Well, uncertainty is something that we are absolutely dealing with at the Fed as we're trying to navigate where inflation is going and where the labor market is going. And as I reach out to businesses all across my part of America that the Minneapolis Fed covers, uncertainty is top of mind for businesses large and small. They're all looking for some vision of where's the destination, where are these trade negotiations going to settle, so they can then move forward with their investment decisions. Until they get that kind of clarity, this uncertainty is overhanging the U.S. economy and potentially weighing on economic activity and obviously creating challenges for us because we're not sure where things are going to settle and therefore where we should go with monetary policy.
We've heard from the Fed again and again that it wants clarity before making a decision on a move. Is there a sense that perhaps you could get some clarity before September? Might that allow the Fed to make a move before September?
I mean, anything is possible. I don't want, between now and September, it's several months, obviously, worth of data that we're going to be looking at. The labor market has so far been remarkably resilient in the face of this uncertainty, though I hear from businesses that they are running scenarios, contingency planning, that if this uncertainty lasts for much longer, they are likely going to have to take some actions to reduce their workforce to position themselves to maintain some level of profitability. And so is that clarity going to be, is it going to be clear enough by September? I'm just not sure right now. Ultimately, we'll have to see what the data says, but we'll also have to see how the negotiations are going. Obviously, if major announcements are struck, meaningful announcements between the U.S. and our major trading partners over the next few months, that should provide a lot of the clarity that we're looking for. So right now, we just have to wait along with everybody else.
Neel, why the need for clarity? Why not just be data dependent for the next 3.5 years?
Well, we are going to be data dependent. I mean, certainly we have been data dependent, and that's one of our hallmarks of our policy process. One of the challenges we have right now is the data, of course, is lagging. And when we know that these tariffs have been put in place, we know that some American businesses knew tariffs were coming, and so they pre-ordered a lot of goods from abroad. So we're not yet seeing the full effect of the tariffs and the trade wars on the American consumer. You know, when I go out to stores in the U.S., store shelves are still full. So we're not seeing the impact of Target or Walmart not bringing in goods that they used to bring in because of tariffs. And so some of the data we know is going to be lagged. And then ultimately, these negotiations, how long are they going to take? And is there going to be a tit for tat? These are the dynamics that we're trying to navigate.
The thing is, Neel, we've had you say that you're confident the economy is on solid footing. I spoke to Jamie Dimon just last week. He says that we should actually prepare for stagflation. How do you square that?
Well, the fundamentals of the economy coming into this year were absolutely strong. We had inflation that was trending down, not quite back to our 2%, running at about a 2.5% level, and GDP growth that continued to exceed our own expectations for the last few years. So those fundamentals were very, very strong. And now there's been policy uncertainty that has been introduced to it. And that's what's causing this environment that we're trying to navigate. A stagflationary shock, if Jamie Dimon is correct, pushes up inflation, pushes down economic activity. But our monetary policy instruments either push up economic activity and inflation or push them both down at the same time. And that's a particularly challenging environment for policymakers to navigate. And that's why so many of my colleagues and I are saying we're really in a wait-and-see mode until we see which of these two effects, activity or inflation, which is the bigger effect that ultimately should drive our policy path.
As it stands now, Neel, how would you rate the chances of a stagflation? 30%, 40%?
Well, I think there's no question that the shock of tariffs are stagflationary. The question is going to be, ultimately, how high do they settle at? Right now, they're at a very high level, highest in 100 years. And how long a period both is this uncertain environment and how long are the tariffs going to last? If we have high tariffs for a month or two, but then they're negotiated much lower, the stagflationary imprint of that is going to be much, much lower. If we ultimately settle at a high rate for the foreseeable future, then the stagflationary impact will be much larger. And so is it stagflationary? Yes. But the question now is the magnitude of the stagflationary impulse, and we just don't know yet.
Let's talk about yields. It is a higher yield environment and much higher than before Liberation Day. We have 30-year yields in excess of 5%. What are you making of the rising yields for longer-dated bonds?
Well, there's a few different components that go into yields. One is the expected path of monetary policy. A second is inflation expectations. Our job is to keep that component down, to keep inflation expectations at 2%. And then there's just investor preferences, what people call the term premium. And if you look at the reason the U.S. has had a trade deficit is because it's just the flip side of a coin. The U.S. has been the premium destination for investment capital around the world. If the U.S. no longer seeks to have a trade deficit, then we would no longer have to be the premier destination for trade or for investment from around the world. And so I think what you're partially seeing is investors are reassessing where do they want to allocate capital to America, to Europe, to Asia. And I think as that rebalancing takes place, you will see yields around the world start to adjust to this new equilibrium. Of course, we're also seeing yields around the world all go up at the same time. So it's not simply a reassessing of the relative strength of these economies, but also questions about, I think, the debt dynamics and the growth dynamics of the global economy as a whole.
So wouldn't you say that the markets, in a sense, are voting on the tax bill in the U.S.?
Well, I think there's a lot going into it. Right now, the U.S. is facing a number of different major potential policy changes. One are tariffs and trade policy that we just talked about. Another one is a dramatic shift in immigration policy. The U.S. had very high immigration levels the last few years that have really been brought way down now this year, and that's going to affect how fast our economy grows in terms of less consumption, but also less production, less on the supply side of the economy. Then you've also got the fiscal policy changes, the tax bill that you just talked about, as well as regulatory changes. So I think markets are digesting all of these changes at the same time, and it's hard to attribute how much goes to one versus how much goes to another of those components.
Do you see the forces influencing the longer-term yields also pushing fund rates higher for longer?
Well, ultimately, we have to set the federal funds rate around our assessment of neutral. The neutral rate, the real neutral rate, is where savings and investment balance out. And if there's less investment capital flowing into the U.S., then you would expect, all else being equal, that the neutral rate will be higher. And that would mean that the Federal Reserve, as we set the policy rate, would have to be responding to that higher neutral rate. And so I think, depending how this shakes out over the long run, it could have an effect on the neutral rate, and then that will affect what the Federal Reserve, how the Federal Reserve sets policy to keep inflation expectations anchored at 2%.
When Moody's downgraded the U.S., it did say that there are expectations that perhaps if the tax bill goes through, the U.S. would end up using 30% of its revenues just to pay interest. And should that happen, we might see mortgage rates go as high as 7%. Is that a base case for you? How are you looking at that possibility?
Well, that's really not the job of the Fed. Our jobs, the assignment that we've been given from Congress, is stable prices, 2% inflation, and maximum employment. And how the government funds itself, how much they want to tax, what they want to spend on, how they service the debt, that's the domain of the U.S. Treasury Department and of Congress. So we leave it to them to think about those issues. We know our jobs, and that's to get inflation back down to 2% and hopefully keep the labor market strong at the same time. And that's what we're focused on.
Neel, what are the companies in your district saying? Are they waiting and seeing? Are they delaying big investments?
That's what they're telling me, that they're waiting and seeing. If they can respond, if they knew where the tariffs would ultimately settle, they can then redesign their supply chain and optimize it around that new destination for tariffs and global tariffs, not just U.S. and China, but global tariffs. But right now, they don't know. And so they don't know whether they should build that new factory in Mexico, in the U.S., in Vietnam, in China or India, for example, just because they don't know where this is ultimately going to settle. And until they know, they really are just waiting and seeing and saying, let's just pause and hold here. And the question is, how long can they hold there? If all businesses are doing the same thing or consumers are doing the same thing, that obviously can have quite a depressing effect on the economic growth and the economic resilience of the U.S. economy.
Neel, we're seeing gyrations in asset classes, including cryptocurrencies. You are a crypto skeptic. The last we spoke, you said that you're going to keep an open mind. When U.S. assets tumbled last week, the U.S. dollar, equities, even treasuries, we saw Bitcoin rallying. What do you make of the movement? I mean, it's so tempting to see, or say rather, that perhaps Bitcoin was the adult in the room.
Well, I'm skeptical of that conclusion. Certainly when inflation took off and the Federal Reserve raised rates aggressively, Bitcoin got crushed. And first we were told that it was going to be a great payment device. It's basically useless for payments in an advanced economy. Then we were told it's a great inflation hedge. And when inflation took off and the Federal Reserve raised rates, Bitcoin got crushed. And so, the use case for Bitcoin and that the advocates make, it just keeps changing, one from the next to the next to the next. It's been 15 years. I'll keep an open mind, looking for some use case in an advanced economy where you actually following the rule of law. I have yet to see it, other than as an instrument of speculation. If people want to speculate on it, they're more than welcome to.
Of course, stable coins also making headlines. Let's take a listen to what Scott Bessent had to say.
What we want to do is apply the highest U.S. regulatory and AML standards to digital assets, especially stable coins. And I've seen estimates that just over the short term, stable coins could create $2 trillion of demand for U.S. Treasuries and Treasury bills. To put that in context, the number is probably about $300 billion.
Of course, we heard from the crypto czar saying that that stablecoin bill will be pushed through as well. Your take on it?
Again, this is the domain of Congress and the executive branch to decide how to regulate assets. I appreciated the secretary saying that you need to have appropriate regulations around the quote-unquote stable coins. I mean, ultimately, what is a stable coin? It is basically a bank. And so if it's basically a bank and it operates like a bank, then it ought to have bank-like regulations to make sure that it is operating in a safe and sound manner. And so I applaud the secretary's comments there, and I look forward to seeing ultimately what Congress and the executive branch decide to do.
Neel, I appreciate that it is not the area that the Fed looks at. I'm just wondering still, though, whether there needs to be a clause, because there seems to be a conflict of interest. We know that the Trump family is involved in stable coins in the crypto space. Is there a need for a clause preventing the president and his family from benefiting from such a bill?
You know, that is things that are outside the domain of the Federal Reserve. That's about as far away as you could possibly go. That is purely up to congressional leaders and legal scholars to opine on, not for me.
Neel, as you take a look at the economy in the next 12, 24 months, what do you deem as the biggest risk?
Well, I think the biggest risk is overhang. You know, how long the overhang of the uncertainty. Historically, trade negotiations and trade deals have taken a long time, months, if not years, to settle out. I certainly hope that the negotiations that are taking place can happen much more quickly than that, so that some clarity can be provided to businesses and consumers in the U.S. and around the world. That is a big overhang that I think we're all going to watch very, very carefully. But then that's just the tariff piece of this. Immigration, as I mentioned earlier, is another major policy change. The fiscal policy situation is another one. And then I'm also, of course, watching yields, global yields, the long yields all around the world, to try to understand what investors are saying about the future of the global economy and competitiveness, and obviously the balance between savings and investment. And so I think there are a lot of things to watch right now that's making this quite a tricky environment to navigate.
Neel, great insights. Thank you so much for joining us on Insight. Neel Kashkari, President of the Minneapolis Federal Reserve. Well, Avril Hong is in Kuala Lumpur for the ASEAN Summit. Avril, what's coming up?
Southeast Asian leaders start 2 days of talks trying to manage this delicate balance between the world's top two economies. Can they hammer out a plan that pleases both sides? That's what's coming up. We'll discuss that ahead. This is Bloomberg.
Welcome back. Let's take a look at how cryptocurrencies are doing, especially Bitcoin, after a strong week for the biggest digital currency amid big swings in more traditional assets. Of course, we saw Bitcoin rallying about 5% last week amid all that volatility impacting U.S. assets. Bitcoin extending that gains, currently up by 1.6%, 109,400 and change. We have Ether as well as Solana also in positive territory. Now, the co-founder and former chair of Chinese photo editing app Meitu sees Bitcoin's total value rivaling gold's within a decade. Billionaire angel investor Mike Cai told us why he is optimistic about digital assets and how he sees Hong Kong setting the path for mainland China, especially on stablecoins.
我们都知道，比特币从2009年诞生到现在。
We know that Bitcoin prices fluctuated a lot since its invention in 2009, but it recently hit a record high of $110,000. It proves that Bitcoin is digital gold, and this is being recognized by more and more people. I believe it will chase up to gold prices in several years. The total value of gold is $22 trillion. I believe Bitcoin will reach the same level within a decade.
When you say it could near gold prices, what do you actually mean by that exactly? What is the sort of the frame for comparison, and what's your target on Bitcoin?
It will grow by tenfold. The market cap of gold is $22 trillion, while Bitcoin is worth $2.2 trillion now. I think it can still grow another tenfold at $1.1 million.
You speak about how regulation impacts the prices of Bitcoin and other crypto tokens. Do you think China will ever change its stance on crypto?
I think for the Chinese government, they want to use Hong Kong as a testing ground. If they see success, I think they may replicate some policies in China. We don't know how long it will take, but we've seen Hong Kong's success encourage Chinese policy development. The Hong Kong legislature passed a stablecoin bill recently. I think we could even see the issuance of offshore RMB stablecoin in the future too.
That's really now how you need to compete in AI. It's your application. It's that application layer where you need to stand out.
I think the market for large language model development is fully saturated. It will be very hard for newcomers to enter this space. Those who remain will struggle for a while. The current competition is focused on AI applications. In the next 3 to 5 years, we will see countless AI applications come to the market, and LLMs will also improve because of it.
You've just made a really major investment into the Hong Kong ecosystem for Web3 with a real estate purchase, but what exactly are you planning to do with that?
I'm not doing this because I'm optimistic about Hong Kong's real estate market. It's because there are physical tech hubs in Chinese cities like Shanghai, Beijing, and Shenzhen, but there isn't such a place in Hong Kong. I see tech companies scattered in different financial buildings. I will establish an AI Web3 concentrated building for entrepreneurs and create a base for them.
How many startups are you planning to be able to incubate, and also what's the timeline for this?
There will be 30 to 40 teams coming into my tech hub in the first batch, which will bring 200 to 300 projects in a year.
And that was Meitu's co-founder and former chairman speaking with our own tech reporter Annabelle Drulers. Meantime, let's take a look at how markets are shaping up here in Asia. They are trending higher along with futures in the U.S. As well as Europe. Barely, though. Reversing some of those gains that we've seen earlier in the morning. MSCI Asia-Pac Index currently up about 1/10 of 1%. Losses, though, for the Hang Seng as well as the benchmark in Taiwan. Still to come, a deep dive into opportunities in emerging markets amid President Trump's shifting tariff policies. Morgan Stanley's Omi Oldenburg will be joining us next. Keep it here with us. This is Bloomberg. Welcome back to Insight. Let's take a quick look at where markets stand right now. We have the MSCI Asia-Pac Index up about 1/10 of 1%. Remember, though, it's given up some of those gains we saw this morning, was as high as 0.5%. Although that positive sentiment remains after Trump extended a deadline on aggressive European tariffs, the dollar retreating to its lowest since December 2023. The US dollar, though, currently has changed direction in negative territory, currently down 0.3%. We have Japan back resuming its trading. Nippon Steel front and center. It is currently up by about 1%. Of course, that's on the back of Trump giving his blessings to a deal between Nippon Steel and U.S. Steel, which was blocked, by the way, by the Biden administration. He claimed at least 70,000 jobs would be created, $14 billion to be added to the U.S. economy. Nippon Steel trending higher by 0.8% as we speak. Now, U.S. Treasury Secretary Scott Bessent expects several large trade deals to be announced in the coming weeks and more in-person talks with China. Bessent spoke with Bloomberg about the impact of revenue from tariffs and why talks with the EU are proving more difficult.
We have substantial revenue coming in now, and there is, at some point, there's an equilibrium rate, let's call it a Laffer curve, for tariffs. And I think we will reach that rate. The other thing that's happening is a lot of their tariff barriers or non-tariff trade barriers. A lot of these non-tariff trade barriers are coming down, so friction's decreasing there. And again, because we don't know where these tariff negotiations are going to end up, they won't end up being scored. But it's several $100 million a year, several $100 billion a year of revenue that will be used. For every $100 billion, that's $100 billion less of bonds that Treasury has to issue.
When you talk about uncertainty and getting more certainty because of the tax bill, some of the uncertainty, a lot of it is because of tariffs right now, because we're not exactly sure where we're going to end up. Do you have a sense when the economic community, the business community, will get better certainty on tariffs?
Well, we've done the 90-day pause. As I've mentioned several times, we have 18 important trading partners. So what everyone should really focus on are those. We've done a deal with the UK. My sense is over the next couple of weeks, we're going to have several large deals announced. We have put a pause and a 90-day pause with China. I expect that we will be negotiating in person with them again. And then the president today, when we initiated the pause and the 10% are moving down from the April 2nd rate to the 10% level was contingent on countries or trading blocs coming and negotiating in good faith. And I think the president was getting frustrated with the EU. The problem with the EU, I've said several times, they have a collective action problem. There are 27 countries. They all have different needs. The Germans, they are interested in cars, the French in agriculture. And then you have Brussels negotiating with them.
That was U.S. Treasury Secretary Scott Bessent speaking with our colleague David Weston. Now let's get more on the tariff uncertainties and the risks as well as opportunities they pose for emerging markets. Amy Oldenburg, head of emerging markets equity at Morgan Stanley Investment Management, joins us now. Amy, good to have you with us. We heard Bessent saying that, several big trade deals are coming, that billions of dollars are also coming to the U.S. economy. Is that enough to sustain the theme of U.S. exceptionalism? Because you say there's actually a reversal that's coming to emerging markets.
Thanks so much for having me. I think one of the things we've seen, even if we just look at valuations in the U.S., we're at 75-year highs in terms of valuations here. We really do think, even though there's lots of discussion about how it benefits the U.S., that this really is a time to start looking at the emerging markets. And much of this will continue to benefit the emerging markets, but that's from trends that have already started taking place way before even this tariff discussion. So we think much of the tariff discussion is just noise around longer-term trends that are already taking shape in the emerging markets.
The thing is, what's different for emerging markets this time around? We've been talking about a revival of emerging markets for quite some time now, but that hasn't really happened.
Of course, but we're starting to really see the stars align now. You've seen the performance year to date. We've seen the dollar weakening quite considerably. That's really given a tailwind to some of our markets. If we look at the performance of Brazil, even India now. These are some of the opportunities that we're seeing in EM, and we're starting to see it's a push-pull dynamic that's really taking shape. So we see diversification coming out of the U.S., but you want that opportunity in EM too, and that's taking shape. So if we look at some of the long-term growth dynamics in places like India or even the China 3.0 story, those are some of the areas we really like right now.
You talked about how EMs are benefiting from the weaker dollar. How much more downside to the USD you think from here?
You know, we do really think there's still some way to go. We could go sideways here for a while. But again, the growth rate differential between developed markets and EM is continuing to widen out. If we do see a slowdown in the U.S., it's that growth differential. We still see nice growth numbers coming out of many of the markets. In places like India, we see interest rates coming down a bit, so that's also helping. And if we do see even a few percentage points coming off of that dollar, that's just another tailwind to help us here. So I think there's multiple factors that are really starting to align that really support that EM story. And again, it's not just one market we're looking at, and this really speaks to the active management dynamic that we see within EM also. I can talk about different opportunities in North Asia, South Asia. Middle East is a really interesting story right now, and even Latin America. So we have multiple factors going for us, and that active management really plays out for us here.
Let's talk about the emerging markets in Asia. With the weaker dollar, Asian currencies are rising, and a lot of the markets here are actually export dependent, and, you know, a stronger currency is not good news.
Exactly, and that's really how you have to differentiate. We've seen some of those top stocks in places like Taiwan very dependent on that export industry. That's going to be a tougher area, but places like, even if you look at the consumer in China, starting to look at that opportunity, it was a bit weak there, but we're seeing some pickup, and especially when we think of things like national brands. So we've really started to differentiate between where there was a lot of pull for luxury brands. The national brands are really taking place of that, and that's an opportunity where we can look for some of those selective investments. Not only is it the consumer in China, but even as we see India taking shape, many people have talked about the higher valuations, tougher to get positioned within India. But as we see the market correcting a bit, it's an opportunity to get in there, and also that long-term consumer in India. So again, just speaking to a number of different opportunities here where the consumer can actually take shape, even if you're seeing that export market not be as strong in many of these markets.
Amy, China is front and center in Asia, and we've seen the recent rally. Is that sustainable?
We've seen some of the earnings coming out now, you know, and some of those market moves. We do think that it is a selective market. We are going to be a bit conscious of where we're putting money, but we do think longer term there is an opportunity here. The China 3.0 story, the innovation coming out of China is something that we need to watch, and I think many other areas of the world are not entirely clear and have the full story of what's happening there. So it's one of the things that I do think we have to continue to spread to the rest of the world is some of that innovation and how that opportunity plays out relative to the U.S. market and innovation in the U.S. market. Clearly a big headline right now.
You talked about homegrown heroes and how that is a theme in EMs. In China, would that mean the tech plays, for instance, on the back of DeepSeek?
Absolutely. So the tech plays on the back of DeepSeek, homegrown heroes, even around sportswear brands, food brands. There's that domestic demand, and we do see that nationalism really taking shape. Again, this is a trend that started far before the tariff discussions. This is something that we've been watching for a number of years now, and we do think will continue, not only in China, but in other places across Asia. Again, just pointing to India, we're seeing a similar dynamic there. So it's one thing we focus on a lot within the emerging markets is looking at some of these local brands that are taking shape, and even we're starting to see some of them export. We've seen some of the EV car makers really start to be seen on the ground, on the roads, if that's in Europe, in Southeast Asia and Africa, even in Latin America. So that's something that we'll continue to watch, seeing some of these national brands at home, but even those start exporting to other emerging markets.
We're hearing more and more that investors want to diversify their portfolio. How is this working out in terms of their portfolio? I mean, how is it looking when you take a look at the flows?
You know, it has been slow. I think one of the things that we've seen, and even before we were just talking about many of the CEOs are having a hard time giving guidance. There's so much uncertainty in terms of some of these discussions around tariffs. We're starting to see slow moves in terms of those, but we do want to, I think many investors are still looking for more certainty in order to make those, take those positions in a more active way than we've seen already. Again, investors don't like uncertainty. It's very difficult to move in the midst when you're not quite sure where that final position is going to be as it relates to tariffs.
You talk about how nuance is important in navigating the uncertainty. Talk to us about that. I mean, what exactly do you mean?
So when we're talking about nuance, I think it's really understanding the long-term themes. So we're really trying to educate more on some of the long-term opportunities that are taking shape, and really positioning for those when the opportunity presents itself. In many cases last year, we were talking about markets and investors saying, oh, valuations might be too high in India or even in places like Saudi Arabia. We have seen some correction in the markets there, and that's an opportunity when you can take in and reposition for a longer-term trend that we feel is taking shape. So I think that's where we're starting to look not only at the tariffs, but some of those other dynamics around long-term growth trends that we want to position for.
Amy, thank you so much for your insights. Amy Oldenburg of Morgan Stanley Investment Management. And still to come, Southeast Asian countries are in a huddle as they rush to come up with a trade plan that can please the U.S. while not upsetting China. We'll be live in Kuala Lumpur next for more on what to expect from the ASEAN Summit. Keep it here with us. This is Bloomberg. Welcome back. Southeast Asian leaders have started 2 days of talks in Kuala Lumpur, seeking to deepen ties with China and Gulf nations and mitigate the fallout from President Trump's tariffs. Bloomberg's Avril Hong is at the ASEAN Summit, and she joins us now. And Avril, we know that this is a region slapped with among the highest tariffs. We have 46% from Vietnam, 24% from Malaysia. It is not business as usual for the leaders here.
Yeah, and we don't know what the outcome of this 90-day reprieve is going to look like. So certainly the focus is on tariffs, on trade, but also geopolitical tensions. I mean, you're hearing already from the Malaysian Prime Minister Anwar Ibrahim speaking to a room full of ASEAN leaders, saying that he's reached out to Donald Trump to seek a US-ASEAN summit. Have a listen.
I've taken the liberty also to write to President Donald J. Trump to seek his understanding to organize a US-ASEAN meeting, which means we observe seriously the spirit of centrality.
Now, for context, it's not just the ASEAN leaders that are meeting in Kuala Lumpur. Tomorrow, there's going to be a trilateral with the GCC and Chinese leaders as well. And even as these fast-growing regions seek diversification, the ASEAN member nations need to be very careful in calibrating their message and not come off as realigning away from Washington. Remember, these 10 member nations are negotiating individually with the U.S. because the White White House has rejected the idea of them negotiating as a bloc. So they have to be careful not to antagonize Washington at a time like that. Now, we also heard from the Thai foreign minister, it's not just about courting new markets and the likes of GCC or China turning their attention to this part of the world. It is also about how these ASEAN economies can further integrate themselves into the global supply chains, including with chips, and integrate with each other. Have a listen to what the Thai foreign minister had to say.
One country cannot, finish the whole products. We have to share the advantage in, the manufacturing. So that means we share the opportunities for supply chain.
Now, keep in mind, when it comes to the ASEAN leaders and what they've been saying in the past week, we've been hearing that they find it increasingly difficult to walk this fine balancing act between the US and China, that path getting increasingly narrow, Has.
Avril, thank you so much for that. Let's discuss what's at stake at this summit with Sharon Seah, Senior Fellow and ASEAN Studies Center Coordinator at the ISEAS-Yusof Asia Institute. In fact, we have Avril standing by with her questions as well. Let's start, Sharon. I mean, how much clout do ASEAN nations have collectively?
Well, I think when you look at them collectively, what they can do is to really just call out on a rollback of protectionist behavior, which is what we are seeing right now. And a lot of that protectionist behavior is coming from the US. So this has been a really wild ride for the region since April 2nd. But I believe that what is going to happen is that the ASEAN countries will continue looking at bilateral approaches to negotiate down the tariffs. So as to a common unified position, I believe that is really very difficult to achieve, but we will still try to do that, be that as it may. It was important for ASEAN to put out a statement earlier that they will not seek retaliatory actions against the US. Of course, we know that's not possible for a smaller economy like ASEAN to do that, but nonetheless, it's still useful to put it out there that we want to continue engaging with the US.
So solidarity among ASEAN members is a big question mark. So realistically, what can be achieved? How much can be achieved?
On the point of trade, because trade is a lifeline for ASEAN, there's a lot of consensus in the region. And as for what the Thai foreign minister says, it's very important for us to continue being a key nodal point in the supply chains globally. And that's where ASEAN's relevance remains till today. So what you have to do now is really to integrate within ourselves, increase the intra-regional trade, which has been dawdling around the 24% mark. If we can remove more non-tariff barriers within the members itself and increase the intra-regional trade, that will be very good news. And I think they can accelerate on so many things, including making sure that we do more on the digital payment front, implement the single windows with our dialogue partners, and importantly, diversify the trade partners that ASEAN currently has right now.
Sharon, I just wonder your thoughts when it comes to the lowering of tariffs. We've seen in the UK and the Chinese experience, those 10% baseline tariffs remain. I wonder what's your assessment on whether, when it comes to the ASEAN countries that are lower in terms of the tariff levels they could potentially face, does it still then make sense for them to give major concessions if they're not going to be able to bring the tariff rate down to zero?
I think the ASEAN countries have come to terms that 10% is going to be the baseline going forward. No one is likely to get a 0%. I mean, even Singapore with an FTA in place, we're looking at 10% going forward in the next few years at least. So for those other countries that have tariff rates at above 46, 49%, they really have to make their own calculus as to how much they are prepared to reset that trade imbalance and how much they are prepared to buy from the US. That will be an individual sovereign decision made by those countries.
Sharon, you talk about diversification earlier. We've seen the French leader in this part of the world, along with Li Qiang this week, the GCC countries' leaders are also going to be here, specifically for some of these Gulf nations. What do you see in terms of the sectors and how they can perhaps be a fresh market for the ASEAN region?
With the GCC, I believe that they're trying to find new markets to export goods that are produced here in Southeast Asia. So traditionally, we've always been buying from the GCC in terms of oil and gas. And also there's been some trade in terms of the halal products. And that's really to expand beyond these traditional import and export sectors. I think they'll be looking into new areas like electronics, and also supplying in terms of food, other types of food sources to the GCC. That will be very useful for ASEAN actually to begin looking into new markets and diversifying that. And also the idea of bringing China into the ASEAN GCC meetings is actually leveraging off the strengths of the ASEAN-China relationship, and to see whether they could perhaps open new frontiers in there. For instance, what they're talking about would be the digital economy and also the green economy, to see whether there might be some comparative advantage between the two regions.
Sharon, given the tariff landscape, does it make sense for ASEAN nations leaning more towards China? Already we saw how Anwar Ibrahim made a visit to Beijing recently. In fact, he made 3 visits in 2 years.
Yeah, that's really very strategic of Malaysia to position itself ahead of the ASEAN chairmanship. And I think whatever Prime Minister Anwar is doing, he has a lot of support from the rest of the 9 leaders, because all of this also plays towards, bolstering ASEAN resilience. Diversification doesn't happen overnight, right? You have to start somewhere, and I'm very happy that we have already got a strong base with many of the traditional dialogue partners of ASEAN. We have 11 dialogue partners, and moving it on with other sub-regional groupings like the GCC definitely would grant more opportunities for this region.
Is it all reshaping the US's role in this part of the world?
What I believe the leaders will be discussing is actually a recalibration of the relationship with the US. So as Avril rightly said, it's about not lining up against the US with China and vice versa. So that tightrope has really gotten a lot narrower and also a lot shorter. It would really require adept navigational skills, both from the chair as well as from the individual members. But I think that they do know really the bottom line is to keep both warm within the region.
Sharon, thank you so much for that. Sharon Seah, ISEAS-Yusof Asia Institute, and of course, our very own Avril Hong in Kuala Lumpur. Now, before we go, here's a look at our show tomorrow. PwC U.S. partner and chief economist Alexis Crowe will be joining us for analysis of President Trump's ever-shifting trade policy and what it means for the U.S. economy and the Fed. That is it for Insight. Horizons Middle East and Africa is next. This is Bloomberg.